Today we're looking at the stock market crash of 1929. Hello, welcome to the Daily Bellringer. Please don't forget to subscribe and take a look at the questions down in the description. Also, don't forget to check out dailybellringer.com where you'll find more resources that go with many of the Bellringer videos. The decade of the 1920s, sometimes referred to as the Roaring Twenties, had been a time of social and cultural change in America and unprecedented economic growth and spending. However, this economic surge was about to come to an abrupt and sudden stop. Throughout the decade, as Americans were spending more money, they were also investing in the stock market. You might be asking yourself, what is the stock market? Many large companies and businesses sell shares or stocks in their company to investors. A stock is basically buying a small part of the company. If the company does well and makes money, the value of its stocks go up, and investors can then sell the share for more than they purchased it for and make a profit. Of course, if the company does not do well, then the value of its stocks go down and investors lose money. The New York Stock Exchange, located on Wall Street in New York City, is the leading trading floor for stocks in the United States. Here, each day, thousands and thousands of stocks are bought and sold. A measurement of how well the stock market is doing is called the Dow Jones, which was created in 1896 by the editor of the Wall Street Journal, Charles Dow, and his business partner, Edward Jones. The Dow Jones, sometimes referred to as the Dow or Dow Jones Industrial Average, measures the average value of stocks among several leading companies in the stock market, and many economists look at it as a measure of how well the U.S. economy is doing. From 1921 through 1929, the Dow Jones had only risen, never dropping but always going up and up as more Americans were spending and investing in companies. Many Americans had grown so confident in the economy and the stock market that they began borrowing money to buy stocks or buying stock on margin by putting a small amount of money down and then promising to pay back the bank for the rest once profits started coming in from their stocks. They believed that the growth of the economy would never stop and that investing in the stock market was a guaranteed profit. Americans from virtually every social class, from the ultra-wealthy to blue-collar industrial workers, were putting their money in the market. People were taking their life savings and mortgaging their homes to get their money in the stock market, believing that they could make enormous profits. By 1929, the Dow Jones had reached an all-time high of 381 points. However, some economists began to see ominous signs as unemployment in America began to rise, farms were beginning to fail, and overall sales for companies were beginning to go down. Despite this, stock market brokers continued to speculate or predict that stocks would continue to rise, and Americans continued to buy more and more stocks and purchase more and more on credit. On Thursday, October 24th, 1929, sometimes referred to as Black Thursday, the stock market crash began. Stock market traders began selling stocks at an unprecedented rate. The Dow Jones dropped by 11% in one day, and the stock market lost over $10 billion in value. This sudden drop started a snowball effect as more and more investors were selling and getting their money out of the market. The following day, on Friday, October 25th, the market stabilized somewhat, giving investors some optimism. However, by the next Monday, October 28th, the Dow dropped by 13%. Then the following day, known as Black Tuesday, October 29th, 1929, the market fell again by 11%. Crowds of investors flooded the streets outside the stock exchange wanting to get the latest news on what was happening with their investments. Over the course of 4 days of trading, the Dow Jones dropped from 305 points to 230 points, or in other words, the stock market had lost approximately 25% or 1/4 of its overall value. The loss would be more than $30 billion in the stock market. This massive drop caused panic as now banks were calling in loans, and Americans who had borrowed or bought on margin to get into the market had no way of paying back the loans. In a very short time, many Americans had lost everything from their homes to their life savings. America and the world was now plunged into the Great Depression. In 1929, the unemployment rate, or percentage of Americans without a job, was about 3%. But within 4 years after the crash, the unemployment rate rose to close to 25% by 1933. It would take a full decade of economic hard times before the U.S. economy would recover. So with that, hopefully you learned something, and thanks for watching.